Much as we've been talking about all morning long, federal interest rates just got higher for the 5th time this year. The 3-point hike, or the 3-quarters point hike, is the highest increase that we've seen in 14 years. But when the Federal Reserve Bank raises rates, what exactly does it mean for you? So Dan Hernandez, certified financial planner and president of Milestone Wealth Management, is joining us this morning to clear things up. So glad to have you here, Dan.
Thanks for having me. Good morning.
You got it.
An important topic, a lot of people talking about it. We know you have some tips, Dan, but before we get to those, can you explain to us why does this keep happening? And does it keep happening because the one before isn't working?
Well, the Federal Reserve has two jobs right now. Well, one is to stem the tide of inflation. The other is to pull us out of a recession or avoid a recession. They've chosen to deal with inflation first. So they raised interest rates. They've been raising them. You're right. This is the fourth time, but the most recent inflation numbers, inflation is still high, over 8%. So that's what's going on. And until that number, the Fed has set a goal of 2% for inflation. Until they reach that, they're going to keep raising interest rates with the expectation of raising interest rates slows down growth, slows down spending, which will bring inflation down.
You want folks to cut back on the spending so that we can slow this inflation down a little bit. That's kind of the ultimate goal, right?
Yeah, but cutting spending is also, slowing down growth could put us into a recession.
Okay, so how does this affect credit card debt and some home equity lines of credit? You mentioned that a lot of folks.
Any kind of debt that's tied to a variable rate. A lot of loans, home equity lines, credit cards, like you mentioned, they're pegged to the prime rate. They're pegged to the Treasury rate. So as rates go up, those rates are going to go up. Companies have lines of credit that they access all the time. Sure. So the cost of accessing that money or borrowing is going to go up, which again slows down spending.
Right.
And what about home buying, Dan? Is it a good idea to get into a mortgage right now?
Well, it is because rates were 8 months ago a 30-year mortgage was 3%. It's now over 6%. So that's a $500 a month change on a $300,000 mortgage. However, it's reasonable to expect rates to continue to go up. So even though they're higher than they were, they're probably going to get
at their highest.
Right. Yeah,
it's only going to get worse.
So if you're in a position you're waiting to lock in, and not only lock in, but lock in at a fixed rate, not a variable rate, because again,
and that's an interesting conundrum, because there's a lot of folks that you're maybe seeing that the housing market is slowing down a bit, and you're like, all right, I'm going to wait for those interest rates, but you don't really know what the timing is going to be with both combined together, right?
Yeah, and there's people that
continue to raise these rates.
Yeah, and there's people that are trying to buy, they're looking, and in the meantime, rates go up, and it's going to cost them more money, even without spending more for the house, it's going to cost them more money. Right. So yeah, it's an issue. But again, that's what the Fed wants, to slow down. The housing market was red hot, 5 months ago, 6 months ago, so they want to slow it down.
And when it comes to rates, are you saying it's best to shop around?
Yeah, oh yeah. I mean, so in general, mortgage rates aren't exactly affected by what the Fed does. There's still a supply and demand component to it. So banks are trying to earn business. Not all rates are going up equally. Some banks are more competitive than others and more aggressive than others. So absolutely, you got to shop around. With
that unknown, with these rates that are rising, talk about the fixed rate investments that we can maybe do instead. Because that's, maybe if you're going to have to invest your money somewhere, that might be a little smarter option these days.
Yeah, if there's a silver lining at all to this mess the last 6 or 8 months, is that interest rates are going up, and if you're an investor or a saver, that's helping you. And if you're okay locking money up for 2 years, 3 years, 4 years, that rate's gone up. You can get 4%, 4.5% if you're willing to lock your money up for 3 or 4 years.
Yeah, which is great, because even 3 or 4 years ago, those rates were less than 2%.
Absolutely. Yeah. So. And as the risk-free rate of return goes up, the attractiveness of taking risk goes down.
So Dan, for viewers who are watching this, the biggest takeaway from this, what's your best piece of advice you can give them right now?
If you're contemplating a big purchase, lock it in sooner rather than later. And if you have variable rate debt out there, either refinance it to a fixed rate or, if possible, get rid of it.
Right. So it's good advice, because obviously, you never know when you need to buy that house, never know when you need to buy that car. So instead of just waiting for that perfect mortgage rate that continue, or perhaps interest rate that might continue to go up, just you say lock it in.
Yeah. I mean, the Fed, the market is already almost priced in another increase after this. And then it depends on what those inflation numbers are. There could be more increases heading into 2023.
Okay. All right. Very good information, Dan. As always, thanks for being here.
Thanks for having me.
Where can people go for more info, Dan?
They can email me at dhernandez@lincolninvestment, ending in T.com.
All right. Thanks so much, Dan.
Thanks, guys.
Appreciate it.